The question sounds simple. Should you pay off your mortgage early or should you invest the extra money instead? Most people treat this as if there should be one correct answer. Pay off the house. No, invest. No, debt is freedom. No, cheap debt is an asset. No, the market wins over time. No, a paid-off home gives peace of mind. That is how the debate usually sounds. But that is not how I would look at it, because this is not only a math problem, it is a risk problem, it is a timing problem, it is a tax problem, it is a liquidity problem, it is a retirement planning problem, and for many people, it is a control problem. When a decision has that many moving parts, strong opinions are usually a sign that people are simplifying too much. The correct answer depends on the system you are in, your mortgage rate, your time horizon, your tax situation, your investment behavior, your retirement stage, your cash reserves, your ability to tolerate volatility, your need for flexibility, your need for peace of mind. If you ignore those variables, you can make a decision that looks smart on paper and still damages your life. That is the important point. A financial decision is not good only because a spreadsheet says it is good. It must survive reality. And reality includes human behavior. In its simplest form, the trade-off is this. If you pay off your mortgage early, you are earning a guaranteed return equal to the mortgage rate you eliminate. If your mortgage rate is 6%, then each extra dollar used to reduce that debt gives you something very similar to a guaranteed 6% return, because you no longer have to pay that interest. If you invest the money instead, you may earn more over time, but that return is not guaranteed. The market may go up, it may go down, it may fall at the worst possible time. It may spend years doing less than you hoped. So the real question is not simply, can stocks beat my mortgage rate? The real question is, can stocks beat my mortgage rate after taxes, after risk, after volatility, and over my actual time horizon? That is a very different question. And once we ask it correctly, the answer becomes much clearer. There are three broad zones. The first zone is the mortgage zone. This is usually when your mortgage rate is very low, roughly 0 to 4%. If you have a mortgage at 2%, 3%, or even 4%, the math often favors keeping the mortgage and investing the excess cash, especially if you have a long time horizon. Why? Because historically diversified stock portfolios have returned more than that over long periods. The S&P 500 has often produced long-term returns in the 7 to 10% range before considering taxes and inflation assumptions depending on the period measured. Even a more conservative portfolio may reasonably target returns above a very low mortgage rate. But the deeper point is inflation. A fixed-rate mortgage can become cheaper in real terms over time. The payment stays fixed. Your income may grow. Prices rise. The dollars you use to pay the mortgage in the future may be worth less than the dollars you borrowed. If your mortgage rate is 3% and inflation averages 2 to 3% over time, the real cost of that debt may be very low. In some periods, it may feel almost like free money. That does not mean debt is always good. It means cheap fixed rate debt can be very valuable. The bank gave you a long-term loan at a low fixed rate. Inflation slowly reduces the real burden of that payment. Meanwhile, if your money can be invested in productive assets, the spread can work in your favor. This is the kind of debt that can make sense to keep. A low fixed mortgage is not the same as credit card debt. It is not the same as a variable rate loan. It is not the same as borrowing to consume. A low fixed mortgage can be a long-term financing tool. That is why someone with a 3% mortgage should be very careful before rushing to pay it off, especially if doing so means missing years of investment compounding. At that rate, the mortgage is not just cheap, it may be getting cheaper every year in real terms. The second zone is the gray zone. This is roughly 4 to 6%. This is where simple answers begin to fail. At 5% or 5.5%, the math becomes much closer. The expected investment return may still be higher, but the spread is no longer large after taxes, after fees, after volatility, after behavior, and after sequence risk. The decision becomes personal, a 5.5% mortgage compared with a 5.5 or 6% after tax. Investment return is not a clear victory for investing. The excess return, if it exists, is a risk premium. You are not getting free money, you are accepting uncertainty for the possibility of a better outcome. That may be worth it, it may not. This is where financial planners often stop giving a clean yes or no answer, because the answer depends on the person. A 35-year-old with stable income, strong cash reserves, a long investment horizon, and the temperament to hold through market crashes may reasonably lean toward investing. A 60-year-old heading into retirement with a large mortgage payment, limited cash flow flexibility, and a need to reduce withdrawals may reasonably lean toward paying the mortgage down. Same mortgage rate, different life stage, different correct answer. This is why personal finance is personal, but it should not be random. The gray zone is where your system matters. The third zone is the pay-it-off zone. Once your mortgage rate moves above roughly 6%, the argument for paying it down becomes much stronger. At 6.5%, 7% or higher. Paying off the mortgage is effectively a guaranteed return at a level that is very hard to replicate safely after taxes and volatility. A 6.5% guaranteed return is not the same as hoping for 7% in the market. The market may return more, but it may also return less. It may lose money. It may fall early in retirement. It may recover only after you have already been forced to sell assets to make payments. Mortgage interest avoided is certain. Market returns are uncertain. That does not automatically mean every person with a 6.5% mortgage should put every extra dollar toward the loan. Time horizon can still matter. Tax advantaged investing can still matter. Employer matches can still matter. Liquidity can still matter. But the higher the mortgage rate gets, the more attractive debt reduction becomes. The reason is simple. The debt is compounding against you. Every dollar of principal removed reduces a liability that is charging you interest. There is no bear market in avoided mortgage interest. There is no sequence of returns risk in a loan balance you no longer owe. This is why paying down a higher rate mortgage is a resilience, optimized decision. It may not maximize upside, but it reduces fragility. And in financial systems, reducing fragility is often more important than maximizing theoretical return. Now, comparing the mortgage rate to investment returns is a good start, but it is incomplete. You have to adjust for at least three things: taxes, risk, time, horizon. Let us begin with taxes. When people say the stock market returns 7% after inflation or 10% nominal over long periods, they often speak as if every dollar of that return arrives in your pocket. It does not always work that way. If you invest in a taxable account, you may owe taxes on dividends, capital gains, and turnover. The more tax efficient your portfolio is, the lower the drag. Low-cost index funds and ETFs can be very tax efficient because turnover is low and many dividends are qualified, but taxes still matter. A return that looks like 7% before taxes may be closer to 5 or 6% after taxes, depending on your income, your state, your investment type, your holding period, and your tax situation. That changes the comparison. A 3% mortgage still looks cheap compared with a 5.5 or 6% after-tax return, but a 5.5% mortgage compared with a 5.5 or 6% after-tax return is a much closer fight. At that point, the spreadsheet is no longer shouting, it is whispering, and when the numbers are close, risk matters more. But account type can change the picture too. If you invest inside a Roth IRA, Roth 401k, traditional IRA, traditional 401k, or other tax advantaged account, the current tax drag may be reduced or eliminated depending on the account type and distribution rules. Dividends and capital gains may not create immediate taxable events inside the account. In that case, an expected 7% return may behave more like 7% inside the account. That can tilt the decision back toward investing, especially for younger investors. This is why you cannot compare your mortgage rate to a generic stock return without asking where the investment is held. A taxable brokerage account is different from a Roth account. A high-fee active fund is different from a low-cost index ETF. A short holding period is different from a decades. Long plan details matter. The second adjustment is risk. Paying off a mortgage is a guaranteed return equal to the interest avoided. Investing is not guaranteed. This is obvious, but people ignore it when markets are doing well. They look at historical averages and treat them like promises. But an average return is not the same as a guaranteed return. The market can fall 20%, it can fall 40%, it can deliver several bad years in a row, it can disappoint exactly when you need money. That is sequence of returns risk. Sequence risk is especially dangerous near retirement or in retirement. If you are withdrawing money from a portfolio and the market falls early, you may be forced to sell assets at depressed prices to fund living expenses and mortgage payments. That can damage the portfolio permanently. A mortgage payment is a fixed obligation. It does not care that the market is down. It does not care that your portfolio needs time to recover. It arrives every month. This is why debt that is manageable during working years can become more stressful in retirement. Your paycheck may disappear or shrink. Your portfolio becomes part of your paycheck. If the market falls, the mortgage still demands cash. So the decision changes as you approach retirement. When you are young, volatility may be something you can ride through. When you are retired, volatility can become something that forces withdrawals at the wrong time. Same investment return assumption. Different risk. This is the heart of the issue. The third adjustment is time horizon. If you are 25 or 30 years from retirement, the data historically favors investing much more often. Over long periods, diversified stock market returns have usually had time to recover from downturns and compound beyond the cost of low or moderate mortgage debt. Time is the friend of investing. A dollar invested at age 35 and compounded for 30 years can become far more powerful than a dollar invested at age 45 and compounded for only 20 years. At a 7% return, $1 invested at 35 and left alone for 30 years can become more than $7. $1 invested at 45 and left alone for 20 years can become less than $4. Same dollar, same return, different time. That difference is enormous. This is why younger investors must be very careful about overpaying the mortgage if doing so starves their investment accounts. The early years are the most valuable compounding years they will ever have. Once those years are gone, they cannot be bought back. But as retirement approaches, the calculation changes. Now the goal shifts from maximizing growth to protecting the plan. When you are 35, the question may be, how do I maximize long-term compounding while managing debt responsibly? When you are 60, the question may be, how do I reduce fixed obligations so my retirement portfolio does not have to carry too much monthly pressure? At 35, a mortgage can be a manageable tool. At 65, the same mortgage payment can become a source of fragility. This is why phase of life matters. The mortgage rate is not the whole story. The mortgage's role in your life changes over time. Now, let us look at the two broad paths. Path one is keeping the mortgage and investing. This path is about growth and optionality. It tends to make sense when the mortgage rate is low, especially in the 2 to 4% range, when you have strong liquidity, when you have cash reserves, when you have a long time horizon, when you are not relying on your portfolio for near-term income, and when you can tolerate market volatility here. The mortgage is relatively cheap. Your capital has the potential to earn more elsewhere. And perhaps most importantly, your capital remains liquid. Liquidity is an underappreciated advantage. If you send an extra $50,000 to the mortgage, you have reduced debt, but that money is no longer easily accessible. It is trapped in home equity unless you sell the home, refinance, or borrow against it. Those options may be unavailable or unattractive in a crisis. If you invest that money in a diversified portfolio, it may be volatile, but it remains more accessible than home equity. This matters. A paid-down mortgage can improve your net worth but reduce liquidity. An investment account can fluctuate but provide flexibility if you have little cash. Paying off the mortgage aggressively can make you house rich and cash poor. That is not always good. A financial system needs liquidity. Liquidity lets you survive emergencies. Liquidity lets you invest during downturns. Liquidity lets you avoid bad debt. Liquidity lets you make choices. This is why I would not advise most people to send every spare dollar to the mortgage if they do not have adequate emergency reserves and investment contributions. Paying down debt is good, but starving the rest of the financial system can create other risks. Path 2 is paying the mortgage down aggressively. This path is about stability and control. It tends to make sense when your mortgage rate is higher, often 6% or more, when you are near retirement, when fixed expenses feel tight, when your portfolio must soon support withdrawals, or when debt creates emotional stress. A paid-off mortgage lowers your required monthly cash flow that can change retirement dramatically. If your portfolio does not have to support a $2,500 monthly mortgage payment, your required withdrawals may be much lower. Lower withdrawals reduce sequence risk. Lower fixed costs make the plan more flexible. Lower obligations increase peace of mind in retirement. The question is not just what return can I earn. The question is, how much income does my life require from the portfolio? A mortgage raises that required income. If the required income is high, the portfolio must carry more pressure. More pressure means more fragility. So paying off the mortgage can make the retirement plan more durable, even if it does not mathematically maximize net worth in every historical scenario. This is why some people who are close to retirement should prioritize the mortgage, even if an investment spreadsheet suggests a slightly higher expected return. The goal at that stage is not only expected return, it is survival under bad conditions. Retirement planning is not a contest to win the highest theoretical wealth number. It is a system designed to pay for life when active income is lower or gone. Control matters. Now, in the gray zone, you do not have to choose all or nothing. This is one of the most important points. People love binary thinking because it feels clean. Pay off the mortgage, invest everything, but in many real situations, the best answer is a hybrid. Invest some, pay extra toward the mortgage with some. This reduces regret. It balances growth with security. It keeps your plan flexible if the market does well. You benefited from investing. If the mortgage rate feels heavy, you are reducing it. If you later approach retirement, the mortgage balance is smaller. If you need liquidity, you did not send every extra dollar into the house. A hybrid strategy can be especially useful when your mortgage rate is between 4 and 6% or even slightly higher depending on your age and risk tolerance. It is not mathematically pure, but life is not mathematically pure. A strategy that a real person can follow with confidence is often better than an optimal spreadsheet answer they abandon under pressure. Now, let us use a specific example. Imagine a $400,000 mortgage, 30-year fixed, 6.5% interest. The monthly principal and interest payment is roughly $2,500. Over the full 30 years, total payments can approach $910,000 with more than $500,000 of that being interest. That is a large cost at 6.5%. The mortgage is not cheap. The decision is no longer obvious. Now imagine the borrower is 35 years old. This person may have 25 or 30 years before retirement. They are likely entering peak earning years. They have a long time horizon to invest. They can ride out market volatility. They may have access to tax-advantaged accounts. Their early investment dollars are extremely powerful because they have decades to compound. If this 35-year-old goes all in on paying down the mortgage and stops investing for several years, they may sacrifice the most valuable compounding years of their life. That can be a mistake. Even at a 6.5% mortgage rate, the time horizon is valuable enough that investing still deserves priority. But ignoring the mortgage entirely may also be unwise because 6.5% is a meaningful guaranteed return. So a reasonable framework could be to invest most extra dollars while still making modest additional mortgage payments. Maybe 80% of excess cash goes toward investing and 20% goes toward the mortgage, not as a universal rule. As a conceptual example, the idea is to protect compounding while also capturing some guaranteed debt reduction. Now imagine the borrower is 45, same mortgage, same rate, different life stage. Now retirement may be 15 to 20 years away. The investment horizon is shorter. Sequence risk is closer. The mortgage could still be around during the retirement transition if no extra payments are made. A large fixed expense could put pressure on future withdrawals. Now the balance shifts. The 45-year-old may still invest, but paying down the mortgage deserves more weight. Maybe the split becomes 60% investing and 40% mortgage, or even 50 divided by 50 depending on the full situation. Why? Because the purpose has changed at 35. The priority is long-term compounding at 45. The priority begins to include reducing future fixed expenses. At 60, the priority may become even more focused on eliminating the obligation before retirement. This is why age matters. The same mortgage rate can mean different things depending on where you are in the life cycle. Now let us look at the opportunity cost in the 35-year-old case. Suppose the borrower pays an extra $500 per month toward the mortgage for the first 10 years only. Because those extra payments hit when the balance is high, they can save a large amount of interest. The mortgage could be paid off around 6 or 7 years early. Total interest could fall by more than $100,000, possibly roughly $120,000 depending on exact assumptions. That is real money. It is guaranteed. It also shortens the debt obligation. This is the emotional appeal of early mortgage prepayment. The savings are visible, the debt falls, the payoff date moves closer. The household feels more in control, but there's another side. If the same $500 per month were invested for 10 years at 7%, it could grow to around $86,000 by age 45. Then if left invested for another 20 years with no further contributions, it could grow to roughly $330,000 by age 65. That is also real money, but it is not guaranteed. So now the trade-off becomes clear. Paying the mortgage early may save about $120,000 in interest and pay the loan off years earlier. Investing may create about $330,000 of future wealth under the assumed return. One side gives certainty, the other gives higher expected value with uncertainty. This is the real decision. Do you want a fixed expense reduction with guaranteed interest savings, or do you want a variable asset that may compound into a larger number? There is no universal moral answer. There is only a system answer. If the investor can tolerate volatility and has time, investing may be superior. If the household values control and is vulnerable to fixed expenses, paying down the mortgage may be superior. If both matter, hybrid may be best. Now let us bring in retirement. Near retirement, the mortgage becomes less like a math problem and more like a spending pressure problem. If you retire with a mortgage payment, Your portfolio must support that payment. If the market falls, the payment still exists. If inflation rises, the payment may stay fixed, but other costs rise too. If healthcare costs rise, the mortgage competes with medical spending. If Social Security is delayed or lower than expected, the mortgage increases portfolio withdrawals. This is why reducing fixed expenses before retirement can be one of the best ways to improve the sustainability of a plan. A lower withdrawal rate is powerful. If your expenses fall, your portfolio does not need to produce as much income. This reduces the chance of running out of money. It makes market declines less dangerous. It gives you more flexibility to reduce spending in bad years. A paid-off mortgage can be a major part of that. Again, this is not because paying off a mortgage always maximizes net worth. It is because it can reduce fragility. And in retirement, reduced fragility can be worth more than a slightly higher expected return. This is where many young investors and retired investors talk past each other. The young investor says the market returns more, so invest. The retired person says, I sleep better without the mortgage. Both may be right in their own systems. One is optimizing growth, the other is optimizing resilience. The mistake is assuming everyone should optimize for the same variable. Now, let us discuss peace of mind. Peace of mind is difficult to quantify. Spreadsheets do not capture it well. You cannot put a precise dollar amount on waking up in a paid-off home. You cannot easily model the feeling of knowing that no matter what happens in the market, the roof over your head does not require a monthly mortgage payment. For some people, that feeling is worth a lot. For others, the feeling of having a large liquid investment account is more important. They would feel trapped if all their excess cash went into the house. They would rather have options, liquidity, and market exposure. Both forms of peace are real. One person feels secure by eliminating debt. Another feels secure by preserving liquidity and growth. This is why the decision must fit temperament. A strategy that creates anxiety is not neutral. Anxiety can cause bad decisions. A person who keeps the mortgage and invests, but panics every time the market falls, may end up selling at the worst time. A person who pays down the mortgage aggressively but then has no liquidity may end up using credit cards during emergencies. The best strategy is not only the one with the highest theoretical return, it is the one you can live with. That does not mean emotion should override all data. It means emotion is one of the variables. A disciplined person uses data to understand the trade-offs, then chooses a plan that fits both the numbers and the human being who must follow the plan. Now, there are other details. You should not pay extra toward the mortgage. If you have high-interest debt like credit card debt, a credit card at 20% is almost always a more urgent target than a mortgage at 4, 5, or 6%. You should not pay extra toward the mortgage if you have no emergency fund. A paid-down mortgage does not pay for a broken car, medical bill, job loss, or urgent family need unless you can borrow against it, which may not be possible at the moment you need it. You should usually take an employer retirement match before making extra mortgage payments. If your employer gives you a match, that can be an immediate high return that is difficult to beat. You should consider tax-advantaged accounts. If you are behind on retirement savings, sending every spare dollar into the mortgage may leave you with a paid-off house but not enough investable assets. You should consider whether the mortgage has a low fixed rate or a variable rate. A variable rate can change the risk. You should consider whether you plan to stay in the home. Paying extra on a mortgage for a house you may sell soon can still reduce debt, but the strategy should be evaluated differently. You should consider taxes, but not overstate them. The mortgage interest deduction matters less for many households now because the standard deduction is high and not everyone itemizes. For some, mortgage interest provides no meaningful tax benefit. For others, it does. You must calculate your situation. You should consider liquidity and asset location. Money in a retirement account is different from money in home equity. Money in a taxable brokerage account is different from money in a Roth IRA. Money in a savings account is different from money used to reduce principal. Every dollar should have a job. A dollar for emergencies needs liquidity. A dollar for retirement needs growth. A dollar for debt reduction needs certainty. A dollar for optionality needs accessibility. The mortgage decision should fit into the whole balance sheet, not be made in isolation. Now, let us think like a system. A household balance sheet has assets and liabilities. The assets include cash, retirement accounts, brokerage accounts, real estate, business interests, and possibly other investments. The liabilities include the mortgage, credit cards, student loans, car loans, and other debt. Cash flow connects the two. Income comes in, expenses go out, debt payments go out, investments receive contributions. The goal is to build a system that becomes more resilient and wealthier over time. Paying down a mortgage improves the liability side. Investing improves the asset side. Both can strengthen the system. The right priority depends on which side is the weaker point. If the household has almost no investments but a very low-rate mortgage, the weak point may be assets. Investing matters. If the household has a large portfolio but a high-rate mortgage and retirement is close, the weak point may be fixed obligations. Paying down the mortgage matters. If the household has no liquidity, the weak point is cash reserves. Build liquidity first. If the household has high interest consumer debt, the weak point is expensive liabilities. Pay those first. This is how you decide, not by slogans, by identifying fragility. Where is the system fragile? Too little liquidity, too much high-rate debt, too little retirement savings, too much fixed expense near retirement, too much home equity and not enough liquid capital, too much market risk, too much behavioral risk. Once you know the fragility, the decision becomes clearer. If the mortgage makes the plan fragile, pay it down. If paying it down makes the plan illiquid and underinvested, invest more. If both are true, split the dollars. That is the framework. Now, inflation is especially important. Inflation helps fixed-rate borrowers because the nominal payment stays the same while the purchasing power of money declines. If wages rise over time, the mortgage payment may become a smaller share of income. This is why a low fixed-rate mortgage can be valuable. People who locked in 2.5 or 3% mortgages during low-rate periods own a financial asset in disguise. The mortgage debt is fixed at a low cost while the world around it became more expensive. Paying off that mortgage early may destroy a benefit the borrower already has. This is why I would be very hesitant to prepay a very low-rate mortgage aggressively unless there are strong psychological or retirement reasons. A 3% mortgage in a world of higher inflation is not a burden to rush away from. It is a cheap long-term liability, but at 6.5% the story changes. Inflation may still reduce the real burden over time, but the nominal interest cost is much higher. The guaranteed return from paying it down is more meaningful. The debt is no longer a nearly free tool. This is why the rate zones matter below 4%. Invest usually has the advantage between 4 and 6%. Personal factors dominate above 6%. Paying it down becomes much more compelling, especially later in life. Now, let us revisit the gray zone because it is where most real people live. The gray zone is uncomfortable because there is no clean answer. But discomfort does not mean confusion if you have a process. Start by asking 5 questions. What is my mortgage rate? What after-tax return can I reasonably expect from investing? How long until I need the money? How much liquidity do I have? Does this mortgage make my retirement plan fragile? If the mortgage rate is low and the time horizon is long, invest. If the rate is high and retirement is near, pay down. If the rate is in the middle and both goals matter, split. Then adjust based on emotion. If debt causes you severe stress and paying it down helps you stay disciplined, lean more toward payoff. If illiquidity causes you stress and you need flexibility, lean more toward investing in cash reserves. If you are behind on retirement, lean toward investing. If you are overexposed to market volatility and fixed expenses are high, lean toward debt reduction. This is not complicated, but it requires honesty. Most people want a rule because a rule is easier than self-examination, but financial freedom requires knowing yourself. Now, one more point. Paying down a mortgage early is irreversible in a practical sense. Yes, you may later access home equity through a home equity loan, HELOC, cash, out refinance, or sale. But those options depend on credit conditions, interest rates, home value, income, lender rules, and market liquidity. In a crisis, those options may not be available. That is why liquidity comes first. I would rather have a reasonable emergency fund and a manageable mortgage than a lower mortgage balance, and no cash debt reduction without liquidity can create hidden fragility. This is why the best answer often starts with sequence. First, build emergency reserves. Second, eliminate high-interest debt. Third, capture employer matches and tax-advantaged retirement opportunities. Fourth, invest consistently for long-term goals. Fifth, decide how much extra should go toward the mortgage based on rate, age, and risk. People often jump to step 5 before handling steps 1 through 4. That can be a mistake. Now, let us think about a person with a 3% mortgage. If that person has 25 years left, stable income, a long time horizon, and no plan to retire soon, paying off the mortgage early may be mathematically unattractive. Investing may build more wealth. Keeping the mortgage preserves liquidity. Inflation helps. The fixed payment becomes easier over time. The only strong reasons to pay extra might be emotional peace, unusual risk aversion, lack of investment discipline, or a desire to enter retirement with no debt. Those reasons can be valid, but the person should understand the opportunity cost. Now, a person with a 7% mortgage. If that person pays extra, the guaranteed return is meaningful. Even a young person should take that seriously. But if the young person is not investing at all, sending every dollar to the mortgage may still be unwise because lost compounding years are powerful. A hybrid can make sense for a 50-year-old or 60-year-old with a 7% mortgage. The case for paying down is stronger. Retirement is close. Fixed expenses matter. The guaranteed return is high. Portfolio withdrawals may soon begin. Debt reduction can make the plan much more durable. The same rate means different things at different ages. Now, a person near retirement with a 3% mortgage. This is a hard case. The math may still favor investing because the mortgage is cheap, but retirement planning may favor reducing fixed expenses. If the portfolio is large and the mortgage payment is small relative to income and assets, keeping the mortgage may be fine. If the payment creates stress or forces higher withdrawals, paying it down may be wise even at a low rate. Again, the question becomes fragility. Does the mortgage make the retirement plan fragile? If no, cheap debt can stay. If yes, reduce it. This is the deeper question. Now, the mortgage is not only financial, a home carries emotional meaning for many people. Owning a home free and clear represents security. It means that if the market crashes, if a job is lost, if the economy becomes unstable, the house does not depend on a bank payment. Taxes and insurance remain, but the mortgage is gone. That feeling matters. But I also want to be careful. A paid-off home is not the same as a cost-free home. Property taxes remain, insurance remains, maintenance remains, utilities remain. HOA fees may remain, inflation can still hit the homeowner, so paying off the mortgage reduces a major fixed cost. But it does not eliminate housing costs completely. A person should not confuse mortgage freedom with total housing freedom. Still, the reduction can be powerful, especially in retirement. Now, investing has its own psychological benefits. A growing portfolio gives flexibility. It can fund emergencies, retirement opportunities, gifts, travel, healthcare, or future investment. It can be diversified, it can produce dividends, it can be rebalanced, it can be transferred, it can be accessed more easily than home equity in many cases. This is why some people feel safer with liquid assets than with a paid-off home. They do not want all their wealth locked in one property. They want a portfolio. They want optionality. That is also rational. The correct decision depends partly on whether you value debt freedom or liquidity more. But remember, this is not either. Or you can build both. Most successful households do. They invest consistently while gradually reducing debt. They do not starve the portfolio. They do not ignore liabilities. They build a balanced system. Now let us talk about behavioral investing. If someone says they will invest the extra mortgage money, they must actually invest it. This sounds obvious, but it is where many plans fail. A person says mathematically, I should keep the mortgage and invest. Then the extra cash gets spent, vacations, cars, subscriptions, restaurants, lifestyle upgrades. Now the person did not pay down the mortgage and did not invest. They simply consumed the difference. That is the worst outcome. The investing strategy only works if the money is truly invested. Ideally, automated. If you choose investing over mortgage payoff, set the automatic investment, make the transfer happen. Treat it like a bill to your future self. If you cannot trust yourself to invest the difference, then paying down the mortgage may be better because it forces the surplus into net worth. Behavior matters. A suboptimal strategy you actually follow can beat an optimal strategy you only describe. This is why data and human behavior must be combined. Now, consider tax-advantaged accounts again. If you are not maxing your 401k, IRA, Roth IRA, HSA, or similar accounts where appropriate, then extra mortgage payments may have a real opportunity cost. These accounts provide tax benefits that can compound over decades. Paying off a mortgage does not create annual tax advantage space. Once a year passes, unused retirement contribution space may be lost or limited depending on the account. That can matter. A young high-income saver who focuses entirely on the mortgage may later regret not filling tax-advantaged accounts earlier. Again, sequence matters. Capture valuable tax-advantaged opportunities before overpaying cheap or moderate mortgage debt. But if the mortgage is high, rate and retirement is near, the answer can shift. This is why the system must be customized. Now let us think about the phrase guaranteed return. A guaranteed return sounds very attractive, and it is, but remember that the return is not liquid. Paying down the mortgage gives you return through interest avoided. You do not receive cash flow unless the payment is reduced or the mortgage is paid off. The wealth is inside the home if you make extra principal payments. But keep the same monthly payment, your cash flow does not improve immediately. The loan term shortens. Interest falls, net worth improves. But monthly flexibility may not change until the mortgage is gone or recast. This matters. Some lenders allow mortgage recasting after a large principal payment, which can reduce the monthly payment while keeping the original loan. Others do not. Refinancing may not make sense if rates are higher, so you should understand how extra payments affect cash flow. If your goal is monthly relief, you need to know whether the payment actually changes. If your goal is long-term payoff acceleration, extra principal works. Again, define the goal. Now let us build a simple decision framework. If your mortgage rate is below 4% and you have a long time horizon and you can invest consistently, lean toward investing. If your mortgage rate is between 4 and 6%, evaluate taxes, risk, age, retirement timeline, liquidity, and temperament. A hybrid approach is often reasonable. If your mortgage rate is above 6%, paying down the mortgage becomes increasingly attractive, especially if you are in your 40s, 50s, or approaching retirement. If you are 35 with a 6.5% mortgage, protect compounding while making some extra payments. If you are 45 with a 6.5% mortgage, balance more heavily toward reducing the debt. If you are near retirement with a 6.5% mortgage, strongly consider whether the mortgage makes the plan too fragile. If you have high interest debt, handle that first. If you have no emergency fund, build liquidity first. If you are missing an employer match, capture it first. If you are not investing at all, do not let the mortgage consume every future dollar. If debt anxiety is severe, give mortgage payoff more weight. If liquidity anxiety is severe, give investing and cash reserves more weight. This is a practical framework. Now let us talk about why people argue so fiercely about this. For some people, debt represents danger. They watched parents struggle, they saw foreclosures, they saw job losses, they lived through crises. The mortgage feels like a chain for them. Paying it off may be emotionally powerful for others. Debt at a low rate represents a tool. They see long-term market returns. They understand inflation. They want assets working. The mortgage feels like a fixed, manageable obligation for them. Paying it off early feels like wasting cheap capital. Both perspectives come from lived experience. The mistake is assuming your emotional history should become a universal rule for everyone else. A person who values security is not foolish. A person who values growth is not reckless. The question is whether the person understands the trade-off. Now let us think about peace of mind as a real asset. Peace of mind can improve behavior. A person without a mortgage may take fewer desperate risks. They may sleep better, they may retire more confidently, they may handle market volatility better because their fixed costs are lower, they may make better decisions because fear is lower. That has value. But peace of mind can also come from having a large investment portfolio and liquidity. A person with $300,000 in liquid investments and a low-rate mortgage may feel more secure than someone with a paid-off house and little cash. That also has value, so peace of mind is not one thing. It depends on what makes you feel in control. For some, control means no debt. For others, control means liquid assets for the best systems. Control means both manageable debt and adequate assets. Now let us address the idea that paying off a mortgage always works. In one sense, yes, reducing debt works. You owe less. You pay less interest. Your balance sheet improves. But in another sense, opportunity cost matters. If you pay off a 3% mortgage early while failing to invest for decades, you may end up with a paid-off home but far less total wealth. That may still be acceptable if you deeply value debt freedom, but it is not costless. No decision is costless. Investing has market risk. Paying down the mortgage has opportunity cost and liquidity risk. The mature investor recognizes both. Now, what about people who say the market always wins? The market has historically rewarded long-term investors, but it does not always win over every time frame. The next 5 years can be poor. The next 10 years can disappoint. The path can be painful. If you need the money at the wrong time, long-term averages may not save you. That is why time horizon matters. Investing is most powerful when the money does not need to be touched for a long time. Mortgage payoff is powerful when reducing guaranteed obligations improves the plan. Do not use long-term stock market data to justify taking short-term risk with money. You cannot afford to see fall. Now let us bring in sequence risk one more time. A retiree with a mortgage must withdraw more from the portfolio to cover that payment. If the market falls early in retirement, those extra withdrawals can lock in losses. The portfolio has less capital left to recover when the market rebounds. A paid-off mortgage reduces the withdrawal need. That can make a portfolio last longer even if the ending net worth in a perfect market scenario might have been lower. This is why optimizing for expected return can be dangerous in retirement. Retirement is not only about expected return, it is about avoiding ruin. The cost of running out of money is much worse than the benefit of having slightly more if markets cooperate. That is why paying down the mortgage can make sense even when investing might have a higher average outcome. The downside protection matters. Now, for younger investors, the opposite danger exists. They may overfocus on security and underinvest during the most valuable compounding years. A 35-year-old who spends 10 years aggressively paying down the mortgage and contributes little to retirement may lose a decade of compounding that can never fully be recovered. At 35, the risk of volatility is real, but the ability to recover is large. At 65, the risk of volatility is more dangerous because withdrawals are closer. So age changes the weight of each risk. This is the life cycle principle: growth early, resilience later. The transition is gradual, not all at once. Now, if I were designing a balanced plan for the $400,000 mortgage at 6.5%, I would start by making sure the person has cash reserves and is investing enough to receive employer matches and build long-term assets. Then I would allocate additional cash based on age. For a 35-year-old, perhaps most extra dollars go toward investing, with some extra mortgage payments. For a 45-year-old, the split becomes more balanced. For someone close to retirement, the mortgage payoff may become a priority if the payment will create withdrawal pressure. Again, these percentages are not commands. They are principles. The younger the person and the longer the horizon, the more valuable investing becomes. The older the person and the closer the withdrawals, the more valuable fixed cost reduction becomes. That is the heart of it. Now let us think about the danger of regret. If you invest everything and the market crashes, you may regret not paying down the mortgage. If you pay down the mortgage and the market soars, you may regret not investing. A hybrid strategy reduces regret because you are making progress on both sides. You will never have the maximum possible outcome in hindsight because maximum outcomes are only visible after the fact. But you can have a robust outcome. Robust outcomes matter more than perfect outcomes. A robust strategy works under more than one future. If markets rise, your investments participate. If markets fall, your mortgage balance is lower. If inflation remains high, fixed rate debt may help, but assets may also help. If retirement approaches, lower debt helps. If opportunity appears, liquidity helps. That is why balance is often underrated. Now, let us talk about the emotional language of owning the house. People say, I want my home to be mine. I understand that. But even after the mortgage is paid off, the home still requires taxes, insurance, maintenance, and legal ownership costs. If property taxes go unpaid, the state has power. If insurance lapses, risk remains. If maintenance is ignored, the asset deteriorates. So paying off the mortgage is not absolute freedom. It is a major reduction of dependence on the lender. That is still valuable, but do not confuse it with zero-cost living. Financial planning should include property taxes, insurance, repairs, and inflation. A paid-off home reduces one large obligation. It does not eliminate all housing risk. Now, what is the final answer? There is no single final answer, but there is a clear framework. At low mortgage rates, especially below 4%, keeping the mortgage and investing often makes the most sense if you have time, liquidity, and discipline. At high mortgage rates, especially above 6%, paying down the mortgage becomes much more attractive because the guaranteed return is meaningful and the debt can make your plan fragile. In the middle, 4 to 6%, the answer depends on taxes, risk behavior, retirement timeline, liquidity, and peace of mind. If you are young, protect compounding. If you are near retirement, protect cash flow. If you are unsure, split the dollars. If you are anxious, build a plan you can actually follow. Do not make the decision only with a spreadsheet. Do not make it only with emotion. Use both. The data tells you the trade-off. Your life tells you the priority. Now, let us close with the deepest principle. The purpose of money is not to win debates on the internet. It is to build a life that works. If paying off the mortgage gives you control, reduces fragility, and helps you stay calm, that is valuable. If investing gives you growth, liquidity, and long-term wealth, that is valuable. If a hybrid gives you both, that may be the most realistic path. The wrong answer is not paying off the mortgage. The wrong answer is not investing. The wrong answer is making the decision without understanding the system. Know your rate. Know your tax situation. Know your time horizon. Know your risk. Know your liquidity. Know your retirement plan. Know your temperament. Then decide. That is how you turn a personal finance argument into a rational plan. And the best plan is the one that lets you feel secure, stay disciplined, and keep moving toward financial freedom, no matter what the market does.